Hot girls keep up with what's happening in financial markets. I don't make the rules, but what I can do is give you a little update. Last night was NVDA's long-awaited earnings call. Basically, this is a conference call where the company gives an update to all investors and the media around how things are going. These are opportunities to build investor interest and manage the public relations of a company. And with these updates, investors learn about the financial health and future plans of a company. Prior to this, analysts and firms put out their expectations for how they assume the company will do, and it's really important to see how far off they are from targets. NVIDIA's earnings were specifically important because they're one of the largest chip makers. They're making chips for Google, Meta, Amazon, all the big guys. And there have been discussions for a while now questioning if we're in an AI bubble, which essentially means are these companies overvalued? Back to the earnings call, NVIDIA actually reported strong profits and revenues, which beat all of Wall Street's expectations. This might be a sigh of relief for a lot of investors, but I do think there's a big learning lesson here. Times like this show the importance of having a truly diverse portfolio and making sure that you're not overinvested in a sector like tech or in a country like the US. On the topic of diversification, Luxus is a luxury asset investment company, and they are introducing a fund where you can invest in Hermes bags. Birkins have an average annual return of 12 to 14%. This is due to a mix of the scarcity, the craftsmanship, the exclusivity, and them being a tangible asset, and investors of this fund actually get first dibs to buying a bag. I think that's really cool. Last but not least, Netflix recently did a 10-for-1 stock split. What this means is anybody that was holding Netflix shares November 10th, for every one share they had, they were gonna get 9 more. A stock split doesn't increase or decrease the value of a stock, but what it does do is split them up into smaller, more affordable pieces. Companies do this when their share price gets really high, and in Netflix's example, their employees were struggling to exercise their options because of how high the price was. Stock splits are usually a good sign and indicate that a company is confident about their future and want more people to be shareholders. That's what happened this week in financial markets, and I will see you next week.